Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Caleb Silver, Editor-in-Chief over Investopedia, and we're going to discuss why we should be investing for retirement in honor of National Financial Literacy Month, which of course is April. Caleb, it's great to have you with us as always. Thanks so much for joining us. And why should you be investing for retirement?
It's great to be with you. And unless you're planning on working forever, you should be planning on saving and investing for retirement. And that doesn't mean you're going to stop work altogether when you reach a certain age, whether that's 65, 70, or 75, but it means you're going to slow down your income. So you're going to need a steady stream of income to last you through the rest of your life.
Now, there's a number of retirement products that are available for investors. Let's run through them. First one is traditional 401k, which many of us should be familiar with as they are offered through your employer.
Right. So these are if you're working for a company and they have a defined contribution plan, typically it's a 401k. They're offered by employers. They give workers a tax advantage way to save for retirement. Now, if your employer offers you a 401k, you can opt in to take those contributions automatically out of your paycheck every month. That reduces your income. But you are taxed when you take money out of your 401k before a certain age. So if you withdraw your funds from your 401k before you reach 59 and a half, you'll be hit with a 10% early withdrawal penalty, as well as other taxes. Now, in the Stimulus Act, in the CARES Act, they did increase the limit to $100,000 you can borrow from your 401k without penalty. That's new based on the CARES Act and the Stimulus Act. But in general, at the age of 72, you have to start taking those required minimum distributions from your 401k plan. And the limits for contributing to your 401k are now up to $19,500 for individuals as of 2020. So 401k is through companies, and companies often match the contribution up to a certain amount that you put in. So those are a great way to save for retirement.
All right, and moving along to our next slide here, the traditional IRA.
Right, this is an individual retirement account. This is one you might set up on your own outside of your employer, and you can contribute pre-tax income towards the investments and grow them tax deferred over time. So there's no capital gains tax or dividend income tax until you start taking that money out once you retire. Now, once you retire, those withdrawals are taxed at your current income tax rate. So capital gains on taxes or dividends are not assessed there as they are in 401ks. And your yearly contributions to your IRA are $6,000 if you're under the age of 50. But if you're over, it's up to $7,000, what they call catch-up contributions. And you must start taking those distributions at the age of 72. But if you want to set up your own retirement account, the IRA is one of the classic ways to do that.
And what's the difference with a Roth IRA?
Well, that's a different way. It's like a traditional IRA, but in reverse. The contribution limits on those Roth IRAs are the same for traditional IRAs, but you don't receive the upfront tax deduction. And you also have income limits for folks contributing to an Roth IRA. I believe it's $90,000. If you make over that, you have to move on to an IRA or a different type of retirement account. So these contributions are made with taxed income. You'll get a tax break later, but they're made with the money you withdraw will be tax-free versus that 401k. So they're an attractive option for people who expect to be in a higher tax bracket or who don't work for a company that offers a 401k. They're subject to required minimum distributions during your lifetime, like all the other accounts. But if you don't use it, you can pass along that money to your kids or your grandkids.
All right, and what's a Roth 401k, and how is that different from a traditional 401k play?
Right, yet another version of ways that companies have adapted the 401k model in a Roth style conversion. So the Roth 401k, it's an employer-sponsored investment savings account that's funded with after-tax dollars up to the plan's contribution limit. Typically, those contribution limits will be lower than what are for traditional 401ks. This option is suited for people who think they'll be in a higher tax bracket in retirement than they are now. So the withdrawals are tax-free when that happens. And the traditional 401k plan is funded with pre-tax money, which results in a tax on those future withdrawals. So it's a wrinkle on the traditional 401k plan and the Roth IRA plan, but attractive to some of those folks who are going to be in a higher income tax bracket later in life.
And yet one more retirement plan, the SEP IRA.
This is great for small business owners. When I had a small business, I started one of these. These are called SEP IRAs for short. It's an individual retirement account that can be opened by small employers or self-employed individuals like freelancers, contract workers. It allows you to have a basic retirement plan without the cost and complexity of a 401k or an IRA. You can take a tax deduction for their contributions, much like a traditional IRA. Employers can do that. and they have a higher contribution limit than either a traditional Roth IRA, which is up to 25% of your compensation, or $57,000, whichever's less. So withdrawals from SEP IRAs are taxed in retirement as ordinary income is, and required minimum distribution will still apply. But if you're starting your own small business, or if you're an independent contractor, this is a great, easy way to do that, and you can really add the contributions up over time.
And with all these options that are available, how do I choose what to invest in?
A great question, and it's the age-old question, but it really depends on your age, and it depends on the age in which you wish to retire, and also your goals for saving and investing. If you had a lot of years in front of you and a lot of years to work, you want to invest pretty aggressively, and that typically means more stocks than bonds. And we used to say that you invest like your age. So if you're 20 years old, you might want to make it 80% stocks, 20% bonds. If you're closer to retirement, you want to be more conservative. So you want more fixed income, more bonds, more money market accounts that have less volatility and less risk, but provide that steady income over time. So you got to plan for 80% of your current income for each year in retirement. And then you got to think about what assets you can safely what assets can help you safely reach your goal in that time horizon. The younger you are, the more aggressive you want to be. The older you are, the more conservative you want to be.
And with people living longer, how much money will I need to fund my retirement?
That is a great question, and it depends on your lifestyle. But the average person is retired for about 18 years, according to the AARP and the Department of the Treasury. Experts say you're going to need 80% of your pre-retirement income. So if you make $50,000 now, you're going to need $720,000 over that 18 years. Despite the guidelines, a June report from the Transamerica Center says that most people have a median retirement savings of only $164,000. So think about how long we're going to have to live after we retire. We're living longer, and our money's not going as far as it used to. Folks don't have as much saved as they need. You got to think about if you're making $100,000 now, you're going to need about $80,000 a year in retirement.
All right, Caleb, thank you as always. We appreciate all the hard work your team's doing over at Investopedia.
Our pleasure, and thanks for having us on.
Okay, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.